this week's theme is going to be cash because I did not buy anything in the past week. So here's an update of where I'm at in the positions which I currently hold. I did not buy any more. I did not add to my positions, nor did I enter any new positions. And quite frankly, from the time that I started doing all of this preemptively at the end of last year, everything has just gone up. And I'm not going to chase. I've been burnt too many times trying to chase, and it just never seems to work out. So I'm not going to do that. So I'm going to stay in cash and wait, preserve optionality till the opportunity occurs, and then I'm going to take advantage of that. And the market's not going to go up forever, but that doesn't mean it can't go up longer than I think it will, and then FOMO sets in, and then I finally buy and then get whipsawed around. So that is going to be a theme in today's discussion, which is, this is a chart of, as we know, I hold BTU and RIG, Peabody and Transocean. This is a chart of Peabody. Today's discussion is going to focus primarily around the idea of once a move starts happening, you never have an opportunity to get into the move. And you just have to sit on the sidelines in cash only to watch things skyrocket that you were going to purchase. Which sometimes, the March low of 2020 is an example of that really happening. So, for a year and a month's time, Peabody created a base, and it kind of bounced around. This is denoting the $4 mark. So it never really traded above $4 for a year and a month. Now it traded all the way down to $1.50. So it stayed in this $1.50 to $4 range for a year's time. And once it finally broke out after that year's basing formation, within 6 months, it shot up over 500%. Now you might say, I missed the move. I missed the move and I could have never gotten in, but that's wrong. This is a close-up of that run-up. And you see these little dips, and that's the problem. You go look at these charts, especially the farther back in time you go, and you just see little squiggles. But those little squiggles are big moves. So you had 4 drawdowns of 10% or more to enter in a position. The final time that it hit $4, it then pulled back to $3.70. That's an 11% move. That's the last time that ever happened. Now, of course, hindsight's 2020, so you didn't know that until it was, well, till now, let's say. But that was an opportunity to purchase. And that was, so this is late April. Then, and this will be a theme, about once a month something happens. And then only a few weeks later, it pulled back in a 10% correction to $5.84. Now, $5.84 compared to $4 is close to a 45% move. So you say it's ran up 45%. It's too late for me to get in. It's overheated. The RSI is saying that's overbought and it needs to cool off and blah, 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 blah. But this is the problem, is nonlinear commodity cycle functions don't necessarily act that way. When you have your spreadsheet gurus trading multi-$100 billion companies and everybody and their dog is looking at the stock, that might be more the case. But these are higher volatile, lower float, more dynamic, nonlinear moves that occur. So here we are. That was a chance to get in. 45% off of where you wish you did get in. Then, a few weeks later, it pulls back in that almost an 18.5% correction to $7.51. So we went from $4 to $5.80 to $7.50. Now you could say, oh, I knew it. Good thing I didn't buy in, because that's how you're going to justify it. Like, I knew it. It's going to keep falling. But of course it didn't. And then only a few more weeks later, it pulled back 20%, almost 21% to $8.71. And then it finally made its way up to about $19, we'll call it. And then from there, it pulled back 50% from September 10th to December 10th. So for 3 months, ignore the little squiggles, even though those are big squiggles, it pulled back 50% in 3 months' time, back to the high $9 range. So we'll call it 10. Now what happened at 10? Where was 10 on this? So 10 was after July. But it never pulled back to $7.51. It never pulled back to $5.84. Your chance to get in was in the high 9s after a 50% correction. After the momentum crowd got out, the weak hands got out, so on and so forth. You know, the window dressing at the year's end, people taking profits, so on and so forth. Or people, those who bought high and then had to dump because a 50% drawdown is a big deal. But remember, so it's at 10. You wanted to buy it at 4. It's still up 150%. If you had bought at $4, after a 50% drawdown, you would still be up 150%. Let's not forget that. And had you bought at any of those other entry points along the way, the $5 one, the $7 one, you would still be up a good amount. And then, as we know today, it's trading around $27, $28. So if you bought at this 50% drawdown at $10, you'd be up 150%. Now this is the trader psychology I want to discuss about all of this. People say things like, it broke that $4 and hit escape velocity and never looked back. Well, that's not true. It looked back multiple times. We just discussed the drawdowns. And then people will say things before you knew it. It was at $20 or high $18, but we're rounding numbers here. Before you knew it, it was at $20. But what do you mean before you knew it? Let's go back. So your last chance was April to get in at $4. So April to September 10th, when it peaked. How many months is that? Exactly. That's not before you knew it. It took 5 or 6 months for it to get there. If there's the average of 21 trading days in a month, and it took 5 months to get there, that's 100 trading days. That's 100 days of volatility, of angst, of emotion, of observation, of due diligence, of research, of market swings, of repositioning. And then people will say, I missed the move. And, well, if you just sat there and watched the whole time, like the lion who watches all the wildebeest run by and never actually makes a decision to latch onto one, and they all finally go off into the sunset, yeah, I guess you did miss the move, which is why you need some kind of an idea of entry point or something. And when playing with these volatile stocks, this is the other point I want to touch on, people like to trade around their position too much. And I would say that if you pick a theme, then you stick with the theme until your theme is proved invalid. Or some new information comes to light that you didn't consider to begin with, that had you considered to begin with, you would have evaluated the situation differently and therefore have never entered your position, in which case then you should probably consider getting out of your position. But people try to trade around their positions using technical indicators, which to some extent can be useful, I suppose. And there's varying ways to trade around your position. You don't have to necessarily sell a portion of your position. You could sell calls on that position. But my point here is that people are trying to save, and I've done this myself. As I noted last week, I got into BTU and I traded around the position numerous times. And ultimately, it seemed to have hurt me when it comes to my P&L statement. And people will try to, but when BTU is a 10% a day either direction trade, you really can miss out on some gains. Now, of course, the counter argument is, well, you can also miss out on losses, but you're really going to have to be perspicacious and in tune with the markets and essentially psychic to be able to save more than you would have alternatively gained if you just sat in your position. Because to trade around your position is to say that you have enough clairvoyance and understanding of future outcomes that you can profit more trading around in short-term time periods than you can just sitting on your hands. So, with this all said, the reason I bring this up is because I've been thinking about this for weeks now, because I've been observing these securities for weeks, months. Is RIG doing the same thing? And I've wondered this. I wondered this a few times, which is it also creating a basing formation? And is the breakout that we've recently had of this formation going to hold, or is it a bull trap? Time will tell. I don't know. But what I'm getting at here is, so I don't want to add to the position because I think it's ran too hard recently. Because I'm up, 23%. And it's not hitting my point the way I decide to buy something. It's not hitting that. And if I think RIG, I'm not going to address this point too much, but say I think RIG's worth $8. Well, then I should just load the boat now, shouldn't I? And the answer might be yes. Or do I try to finesse the trade, trying to buy in at these detailed entry points and fiddle around with it and never actually get a large position going and so on and so on. Time will tell. But I'm also entertaining and looking at other companies that I would like to purchase that also are not hitting that's why I didn't buy anything this week. The market has ran hard in the last 2 or 3 weeks. That doesn't mean it can't run hard for another 2 or 3 months. And if it does, then I suspect I'll be sitting in a lot of cash. But when you look over across enough sectors and industries, something somewhere is going to pull back while something somewhere else is going to be running hard. There's always a bull market somewhere, and there's always a bear market somewhere. And so, if anything, this cash position, as it accrues, will help me be able to diversify and execute optionality in the near future. Within the next couple of months, I can't imagine that there won't be a buying opportunity in the near term. And thankfully, I'm doing this for the long term, so the short term shouldn't bother me too much. And that's really the discussion today. Is RIG doing what BTU did a couple of years ago? Now, of course, the basing formation here is 8 months longer than it was on BTU. So, we'll see what happens. Thank you.